Alright everyone, welcome back to another video. In today's video, we're going to continue the topic around net operating income and operations in commercial real estate. And in particular, we're going to take it back to basics and cover how do we calculate NOI? How do we calculate net operating income? Let's get started. So on the agenda, this will be short and sweet. We're really just going to talk about NOI and how do we calculate it. So first things first, just in case, what is NOI? What is net operating income? And so NOI is this reference to the amount of income that you can generate on a property based on the difference between revenues and expenses. Now, this I think leads to the question, right? Like, where do you get NOI from? Who gives it to you? So I think there's really two main sources. There's one, outside sources, property managers, brokers, lenders, appraisers, even the owners, right? They can provide documents or statements or spreadsheets that look something like this. It summarizes all the revenue that gets collected, all the expenses that get paid, and what is left over. That leftover is that reference to NOI. So you can get it in the form of a historical financial from a property manager, or you can get it in the form of a forward-looking pro forma from, let's say, a broker who's marketing a property for sale. Now, if that's one source, the other source is your own. You can create your own estimate of NOI. So this leads us to the point of the video, right? How do you calculate net operating income? So there's 5 main steps. We'll start off with estimating what is best case potential gross income. We'll make a deduction for vacancy. The difference between the two results in effective gross income. We'll make a deduction for operating expenses. The difference between effective and operating expenses is NOI. So let's dive deep into each one of them for a minute. So first is potential gross income, or sometimes potential gross revenue. This is a reference to the best case potential, hence the name, income or revenue that you can generate. And so if we think about all of your space being occupied and all of your tenants paying on time, that's the best case source of all revenue that you can collect. So for multifamily properties, for example, we'll take all of our units, multiply it by the rent that we think we can collect, times 12, because oftentimes in multifamily, they pay on a monthly basis. For an apartment building, that's one way, but how about we talk about commercial property generally? So if we think about shopping centers, office buildings, warehouses, and so on, it is going to be a product of the rentable area that you have, typically in square feet, multiplied by the market rent. That market rent could be quoted on a price per month basis, price per square foot per month basis, price per square foot per year basis. So as long as you're mindful of the frequency or the unit of measure, I think we'll be all right. But generally speaking, rentable area times the rent rate. So next in line is making a deduction for vacancy allowance. So I think it's reasonable to assume that your property isn't going to be 100% occupied all the time, and that it's not going to be occupied by tenants who pay on time every time. So you make a deduction or an adjustment for issues associated with occupancy, issues associated with tenants who don't pay. There's a couple different kinds of vacancy allowance, which we also have another video about. But right now we're really just talking about this generic allowance for things not always going to plan. So one way for us to estimate this is we'll take that estimate as a percentage basis and multiply by potential gross income. Another way is, let's say the property manager will give us an estimate, but I think in this example, at least we'll keep it easy and we'll say a percentage rate of market vacancy times PGI. So effective gross income, the amount that you can actually collect or effectively collect, is the difference between PGI and vacancy. Next, we'll make another adjustment, another deduction for operating expenses. So you as the owner have to pay items like property taxes, insurance, utilities, a property manager. You can get these estimates from either historical figures or estimates looking forward or ahead from property managers, appraisers, and other folks. But right now, I think the focus is really just this understanding that you have to make a deduction against EGI. You have to make a deduction for all the expenses that you'll incur for being the owner of the property. It's your property, so it's your responsibility. And so the difference between EGI, effective gross income, and operating expenses is net operating income. So I typically pause whenever I talk to folks about NOI at this point, because if you've made it through elementary school, chances are good you know how to do subtraction. And if you know how to do general arithmetic, subtraction, addition, multiplication, you can probably get through calculating NOI. This is less about the math, and it's more about the order. It's more about the definition of each one of these line items and what they really mean to you. So one more time from the top, PGI less vacancy equals effective gross income. Less operating expenses equals NOI. So let's take a look at an apartment building as an example, just so we can take a look at how we can apply some of these numbers in this order. So let's say you have 10 units. They rent at $2,000 a month for 12 months. So 10 times 2,000 times 12 is $240,000 a year. Now let's assume that there is a 10% market vacancy allowance. So 10% of 240,000 is $24,000. So EGI is the difference between the two. So now we have effective gross income of $216,000. Next, we'll take out an estimate or actual of operating expenses. So let's take out $100,000, which leaves us with NOI, the difference between EGI and OPEX. So $116,000 is left over at the end. That's our estimate for NOI. That's how you would calculate NOI. And that's it. You're done. You can go out, you can grab a drink. Your job is done here. So just to recap, NOI is one of the core components of understanding how to value real estate, in particular commercial real estate. The way that we estimate NOI is we start with estimates for potential income, make a deduction for vacancy. We end up with EGI, effective gross income. We make another deduction for operating expenses, and we get NOI. So that's it for today. I hope you enjoyed this video. I hope you learned something. If you have any questions, please feel free to reach out. Otherwise, I'll see you in the next one. Thanks.